Hey, Jason Rogers here, and I quickly want to talk in this video about my strategies when offering equity investments into the marketplace. Specifically, when I am offering an investor an opportunity to invest alongside myself in the investment groups that I represent. When I'm offering that opportunity to an investor, how do I like to structure that offering, and what types of terms do I like to include? Pretty simply put, my strategy is as follows. Offer them an investment opportunity so good they cannot deny at least looking at it. You want to give them something with enough meat on the bone. And my general premise is give them price so that you can negotiate terms. And here's what I mean by that. Ultimately, I believe you want to give them a really good investment, a nice baseline preferred rate of return, a double-digit baseline dividend combined with a small equity position in the subsidiary or subsidiaries that they are helping you acquire, right? So firstly, you're giving them a preferred dividend. I like 10 to 15%. You are essentially saying of the free cash flow after debt service that this business or these businesses produce, I will firstly give you a 10 to a 15% dividend on your investment per year, right? So you're giving them a baseline dividend that's quite attractive. And then secondly, you are also giving them, say, 5 to 10 or maybe 15% of the equity of the subsidiary or subsidiaries. And what that means is essentially it's an LLC or a subsidiary. It's a legal entity, and you have, say, 1,000 shares, and you give this investor 100 of those shares. Or if there's 10,000, maybe you give them 1,000 or 500, right? You give them 5 or 10% of the equity of that subsidiary. And so that means all profits, 5 to 10% of those profits get passed along to the investor. Now, here's the real punchline, though, because that's the structure. All right, I just gave you the structure, and investors are very interested in that structure as long as you have proper deals, and therein lies the punchline, right? You have to have good deals, deals that you know how to operate, that have every logical reason in the world to produce legitimate return on capital, right? And this is where you look at the trailing 3 years. You look at tax returns, you look at financial statements, you look at balance sheets, you look at statement of cash flows. You obviously do your due diligence to ensure that the sales are legitimate, that the expenses are not overinflated nor underinflated, the expenses are accurate and actual. And then from there, you have what should be obviously a cash flowing entity. Now you will be using debt to make the acquisition, and that debt is going to cost capital, so you have to work that into your financial model. I've made multiple case studies showing you basically exactly how to analyze businesses, but from all of this, you should be able to easily pay out investors both a preferred rate of return and a dividend from profits based on their pro rata equity position in the subsidiary. And from that point, you bring on investors. And look, if you just bring 10% of the capital stack in cash to a bank, you increase your odds of being able to get the deal done. You can combine a little bit of a seller's second position, right? A seller's second note. That's almost the equivalent of a mezzanine note, but it comes from the seller. You could also, of course, work in a mezzanine second position note. That's going to be higher interest either way, whether it's a seller's second or mezz. Traditionally, I find the seller's a little bit more willing to drop the interest rate because you're about to give them a lot of cash, whereas a mezzanine lender is working on a very one-to-one basis, so they're a bit more aggressive in negotiation. What else can I say? Ultimately, again, it comes down to the deal. Is it a hot deal or not? If it's not a hot deal, don't do the deal. And this is again the punchline, and this is why I'm so focused personally on operations and due diligence as opposed to fundraising. Look, I don't make 100 cold calls a day calling out to investors. I don't send them 100 DMs or direct messages or emails to investors, not even close. Now, I have individuals that are partners with me in my endeavors that do a bit more outreach, but nevertheless, even them, we're all principally focused on great deals, finding those great deals, negotiating those great deals, structuring those great deals, both from a legal and a financial perspective, doing the financial audits, doing the operational due diligence. When you do all of these things, and of course, firstly, you chose the right sector, you chose a fundamentally great sector, ideally one that's recession resistant, a great sector that has consistent cash flow but simultaneously has great upside, or at least good upside, a sector in a strong geographic area that ideally a geographic area that's growing, that's flourishing, right? When you combine these great factors together, you have a promising investment opportunity. You then put together the right leadership and operational team, and from this place of really having all your ducks in a row, you've done the due diligence, you have a hot deal, now you bring this to investors and they're interested. And here's the punchline. You talk to those investors before you actually officially present them with an opportunity, right? So you cultivate these relationships prior. Now, easier said than done. There's a lot of moving parts here, but this is not an easy game we're talking about here. M&A is not just something that you whip together. This isn't 5-minute easy mac. This is complicated, legitimate business, but those who can put these pieces into place successfully will be more successful, or at least sure as heck more likely. And again, these are the very structures as far as procuring investment, thinking about the investment vehicle first, and really picking the right sector. These are the things we're doing. It is working for us. It's not easy. We're working 15, 20 hours a day. I'm literally shooting to this video for you at about 3:15 in the morning. I mean, it is early morning stuff, but I'm shooting this video for you because I had these ideas at the top of my head and I wanted to share them. And I'm up early because I'm working hard to make sure that we're gonna be successful in these quite interesting times we find ourselves in. So ultimately, look, if you've liked this video, thumbs it up, share your comments below, subscribe, and I will talk to you in the next video.